What's really unique and want to highlight is the idiosyncratic and non-cyclical demand drivers of gold that make it a unique underlying asset.
The powers that be that are politically appointed and elected generally don't care to have people revolt in the streets over deflation when they have the ability to hit the print button.
Of course, I'm a little bit biased, but what I will say is that the gold ETF, they're 33 Securities Act products. They're a very efficient way to transact in the market.
Information presented on this program is believed to be factual and up to date, but we do not guarantee its accuracy, and it should not be regarded as complete analysis of the subjects discussed. Discussions and answers to questions do not involve the rendering of personalized investment advice, but are limited to the dissemination of general information. A professional advisor should be consulted before implementing any of the options presented. Encompass More Asset Management LLC is a registered investment advisor with the U.S. Securities and Exchange Commission and only transacts business in states where it is properly registered or is excluded or exempted from registration requirements.
Hey everyone, welcome back to another episode of the Tall Oaks podcast. Today I am joined by Akash Doshi, the head of Global Gold Commodities at State Street. Akash, obviously you focus a lot on gold, and gold's been a pretty hot topic for those paying attention this year. Give us a quick insight or rundown briefly on like what's happening in the gold markets. Why does anyone even care? And why is it something people should be paying attention to?
Yeah, that's a great question. 2025 has been a historic year for the yellow metal, strongest returns that we've seen since 1979. And I think a big driver really bifurcates into two areas. So from a macro perspective, I think the weaker dollar has been the number one driver, just from a pure technical and valuation standpoint. The US dollar, whether you look at the major indexes like the DXY or the Bloomberg Dollar Index, BBDXY, that devalued the most in the first eight months of this year since the 1970s. So it was a real dollar slide. And through denomination effects, gold has rallied substantially in 2025, the most since 1979. So weakest dollar trend since the 1970s, strongest dollar performance, gold performance, since the late 1970s. So I think that's been the big driver from a macro perspective. And I can dig in on a lot of other factors that have affected the gold market. But then from a flows perspective and from a supply demand perspective, I think it's the return of Western ETF investors, in particular, North American and US investors, really adding gold allocations this year for the first time since the 2020 pandemic. And I think from a physical supply demand standpoint, that shift out in the demand curve, that real inflow that we've seen in ETF buying, that's been the big driver on the gold price as well. So the combination of a weak dollar and a robust ETF inflow cycle, I think those have been really the primary drivers for gold's outperformance this year. And it's likely set to continue, I think, in 2026, although at a more moderate pace.
Yeah. Do you have any insight that you can share as far as like when we're talking about ETF inflows and this demand in the Western countries, who is the demand, right? So is it large institutions that own it? Is it hedge funds buying it? Is it, small people on their Robinhood account, small investors on their Robinhood accounts? Where is the source of flows really coming from?
That's an interesting question. And I would say in 2025, it's really all of the above. So at State Street, our Spider Gold Suite, GLD and GLDM, is not only the largest gold and precious metals ETFs in the world, but they're the largest commodity funds in the world, with AUM, or assets under management, as of December 2025, roughly around $160 billion, give or take. And within that context, this year, just in our own suite, we have seen inflows across all verticals. That starts with direct retail, but that includes the intermediary channel or private wealth channel, including RIAs and wirehouses and broker-dealers, and then also includes the financial institution groups and institutional channel. So across all channels, we've seen inflows this year. To take a step back and really answer your question, though, is that this is a market reversal from what the global ETF gold landscape was witnessing over the prior several years. And this is why I think ETF inflows have been so critical for price discovery in 2025. So what do I mean by that? 2020, the pandemic or COVID shock, was a very strong year for gold ETF inflows and prices. That's when we started that $2,000 level that was breached and kind of found that new support area for the market. But by late 2020, all the way up through mid 2024, global gold ETF holders were destocking. They were redeeming shares. And the majority of these products are 1933 Security Act products. So they're physically backed. So these gold ETF holders were providing supply to the physical market throughout 2021, throughout 2022, 23, and even the early part of 2024. It was really only last summer of 2024, when that outflow cycle reversed into inflows, but it was only a trickle during the second half of 2024. In 2025 is when it became a more structural force. That's why the first paper I wrote at State Street Investment Management this year, it's still on the website, published at the very beginning of January after New Year's Day of 2025, was why gold ETF inflows will drive record prices in 2025. Because I felt if the ETF redemption cycle became a restocking or an inflow cycle, that would really shift out gold demand, and that would require higher prices to rationalize other pockets of consumption. Are the central banks going to give back some? Is China retail going to give back some? Is physical bar and coin demand going to go down? Because that delta for the ETF restocking has been so large this year versus the outflow cycle that we saw, particularly in 22, 23, that it kind of overwhelmed the market. It tightened physical balances and allowed prices to really rebase higher in 2025.
You keep mentioning like gold ETF demand, right? And I think that brings up an interesting observation that I've had in the financial planning space, right? So obviously in our wealth management firm, we deal a lot with clients and you know how they choose to handle their wealth. And starting post-COVID, we started having more and more conversations where people were like wanting gold, right? You saw the initial leg higher in the COVID run. I think that's when it initially broke 2,000. And people were quite interested. And I happen to have my older brother works in the physical, you know, what you would call the coin and bar space, right? And one of the lessons I've learned from him is like you pay a quite significant premium typically getting physical gold. And then you actually have to pay another premium in the form of a discount when you sell it back. You try to get rid of it, right? And so there tends to be this really big friction cost. And so from that perspective, I really enjoyed the experience personally of like gold ETFs and having something available that's like a gold ETF, right? It's easy to access. I don't have to go out and buy a whole 1 ounce coin. I can buy one share, right? That is significantly cheaper. So if you're a smaller investor, it's really nice. But it allows you so easy access. And then there's this tax efficiency that comes in if you're a taxable investor, right? Where if you're like a lot of our clients are charitable in nature, they do a lot of gifting and donating to various organizations. It's hard to walk in, not to say that it can't be done, but it's difficult to walk in with a gold coin and say, why don't you take this and give me a receipt so I can make sure to take the tax deduction. The IRS is not going to have any issues with that. And, you know, if your paper trail is really super clean, you'll be okay still. But with ETFs, you can, you know, in-kind donate them after they appreciate it. And so this tax advantage if you're a charitable giver. And because the bid-ask spread is so tight, typically on the ETFs, the expense ratios are so low. You don't have to store it. You don't have to insure it. There's just really low friction costs. It's actually, I think, a very cost-effective way to access that market. And on top of all that, one of my favorite aspects is you don't have to keep hundreds of thousands of dollars at gold at your house that you now have to keep, you know, a loaded rifle by you at all times or something should somebody know you have it. And so there's this, you know, an element that way when you talk about holistic wealth management that I find really interesting. Additionally, for our wealthier clients, they pledge it as collateral. So they might pledge their gold as collateral, use a pledge asset line, and use liquidity through that channel for whatever other various operations they have going on in life. And so it's convenient. But one of the concerns that people have brought up, and I think we address it, but I think it's a real concern people have, or I would say they don't even have this concern initially, but they don't quite understand it, or they're being preyed upon by, what I call the physical gold IRA people, which is like they've got a vault somewhere and they'll sell you ounces of gold and you have it in their vault. And so you get it through like a self-directed IRA or something like that. And one of the things that they would say is, well, those people told me if I have a gold ETF, that's paper shares. It can go away. It doesn't exist. It's not physical. It's, with them, it's actual physical gold in a physical vault. And, I think if there's anyone out there that's an authority on the topic a little bit, it ought to be you. Can you help shed some light on, what's what is it really like when people say, oh, it's a gold ETF? What does that really mean? Is it paper?
Sure. And you did a great job explaining some of the background of the product. Of course, I'm a little bit biased, but what I will say is that the gold ETF, they're 33 Securities Act products. They're a very efficient way to transact in the market. It is liquid. It has a very tight bid ask. You can see it on your screen along with your tech stocks, with your S&P 500 exposure, with your fixed income exposure. And to that end, you mentioned even, and we should all be thinking about it in the giving season, charitable donations, et cetera. You can pledge it like a security, like you would any other stock, to a charitable organization, as well as it's active in the securities lending market. So when I hear that you can only own physical, I don't try to argue against someone that believes that gold is a bearer asset and that you can have some physical. The question is how much, and then what are those frictions? You mentioned, Brendan, that transacting in the physical market is not cost-free. You pay a huge markup, typically 3, 5, it can be as large as 10 or 15%, depending on the institution and entity, to buy the market or have the bid side. And then if you're looking to liquidate, it ends up being another transaction cost on the way out as well. That can be several percentage points away from spot. So even if you look at the largest vault banks for private banks and ultra high net worth clients globally, whether it's the Swiss banks, some of the large US banks, even their premium customers are paying 2, 3, 4% bid ask because you have to store the physical gold. You have to insure it. There is are there frictions involved in accessing that? The ETF structure is physically backed. The funds, GLD and GLDM, but I'll just focus on GLD, our flagship fund. It is a physically backed 1933 Securities Act product. Every share that's outstanding is backed by 1/10 of an ounce of gold. There's a healthy create redeem process for those gold shares so that when shares are created, it requires authorized participants in our dealer system to go out, extract that physical gold from the London Bullion Markets Association spot market, the global liquid benchmark for physical gold, get that gold, and then make an irrevocable transfer to the Spider Trust. Also, those gold bars that are held in the trust are published every day. It's transparent from that purposes, and it's also audited by a Big Four auditor. And from a financial standpoint, but then it's physically audited multiple times a year, including surprise visits. So I think from that standpoint, uh, knowing how long these funds have been around, particularly GLD since 2004, knowing that they've withstood the global financial crisis, they withstood the European and Eurozone debt crisis, they've withstood Brexit, they withstood the COVID shock and pandemic shock, and here the fund still is at record assets under management. I think we can contextualize it as a product that has buy-in from an institutional and retail global gold community, and it's part of the gold ecosystem. I would say the other advantages of being involved in the ETF side, particularly with GLD, beyond its liquidity and tight bid-ask spread, is if you wanted to utilize option strategies. GLD has about 95 to 98% share of gold ETF options activity outstanding. So if you wanted to use options and overlay strategies, really GLD is the way to go. You can technically do that with physical gold, but it requires a large private bank relationship, a lot of over-the-counter transactions and contractual work to really monetize gold volatility
Yeah.
or to earn income from your gold. Whereas the ETF market for gold led by GLD, and the GLD ETF market has a very active options space.
Yeah. Um, we've talked a lot about the ETF structure. We've talked about the ETF demand, or rather the ETF flows. Let's talk about what creates like the ETF demand. And you know, I tend to deal with people in the RIA space, obviously, which tends to mean, you know, high net worth clients, but also we work with a lot of mass affluent, you know, what I'm going to air quotes here, regular people, right? Not wildly sophisticated people. Particularly, like a lot of our clients wouldn't know what a Sharpe ratio is. They don't really talk about risk adjusted return as a major driver of what keeps them up at night. But what is driving, you know, this idea of gold in a portfolio? Because I spend a lot of time in the financial planning space and in financial planning circles, and there's this huge dichotomy between all of my institutional portfolio manager friends that all have this opinion of like gold's a great asset in a portfolio. You know, it's awesome, low correlations. I don't know why it goes up. It just does, but I know what it does with portfolio numbers. And then in the financial planning space, it's like totally opposite. And they say it doesn't produce income. There's no dividends. It doesn't produce anything. And so, you know, if you're looking for an inflation hedge, you'll do better with tips because you're promised to beat inflation, you know. And if we look back the last couple of decades, gold has ripped tips face off, to say the least, in terms of you know, total return. So is there something the institutional managers tend to know that the financial planners don't? Is the financial planners, you know, miscalibrated in their analysis when they're trying to allocate clients' capitals? You know, and if so, what's the shift that's happening that's potentially causing this demand?
Sure. So I think first is taking a step back and thinking about the strategic case or strategic role of gold in a portfolio. So I'd like just to answer some of those points because I acknowledge some of them, that gold doesn't pay a dividend yield. It doesn't have a coupon, but it does provide other portfolio attributes.
Mm-hmm.
So first and foremost, let's contextualize the market from a broader lens. And we'll start in the early 1970s, 1971 to be exact. That's the year, in August of that year, we had the Nixon shock and the US dollar delinked and became free floating. And that's the kind of the post-Bretton Woods system. So I picked 71 on purpose, not because that was before you and I were born, Brendan, but it just so happens to be the year of the Nixon shock in 1971, and I think a fair place to start in a gold market standpoint. So here's a couple of things that I would say. One is that over the last 5.5 decades, people are surprised to learn, gold has produced average annual nominal returns, log normal scale, of 7 to 8%, and actually closer to 8% over those 55 years. Second, so it's providing capital appreciation. Second, and you mentioned this, it's doing that is a diversifying asset that typically has very low correlation, certainly low static correlation to equities and bonds over a long horizon. And that's important because gold in your portfolio, one of the attributes is that it's a real diversifier. It's that left tail hedge. It's that safe haven hedge. And I think that's really critical. And third, I would add, and this is really even more of a post-pandemic phenomenon, but really post-global financial crisis phenomenon, gold is an alternative fiat slash inflation slash debasement hedge. And what I mean by that is, I think in the post-pandemic regime in particular, what's been a big driver of gold demand from ETF investors in the last couple of years in particular has been concerns about global debt loads. And gold is an alternative fiat that hedges against currency risk and currency debasement risk, loss of purchasing power, and so forth. Because I mentioned that over the last 55 years, roughly 5.5 decades, 71 through 24, you had simple returns of close to 8% in a log normal scale, but real returns average 3 to 4%. So gold is beating cash plus inflation. That's its job as a low volatility asset that's less volatile than equities. So I think you put all of that together, gold has a unique role in your portfolio. And as portfolios shift from 60/40, 70/30 constructs to more along the lines of 60/30/10 or 55/30/15, then that last bucket, that 10, 15, 20%, that alternatives bucket, I like to call it, that's going to include liquid alternatives. It's going to include illiquid alternatives. Gold deserves its own role there because it is a low correlation asset. It is a portfolio diversifying asset. It's withstood the test of time. And I really look at it as kind of your left tail hedge asset in that regard. So yes, it doesn't pay a dividend yield. It doesn't have a coupon, but it provides other attributes. And I'm happy to dig in on why I think particularly long bonds are a little bit of a risk in this macro and market environment with inflation, uncertainty, Fed policy uncertainty, and so forth, and fiscal impulse, and how gold fits in to portfolios in that regard as well.
I would actually really like to hear your take on that. And the reason why is I largely view gold oftentimes through the lens of more like a zero coupon long bond. And I think one of the most compelling trades long term that I'm sort of interested in is this idea of like actually long gold, short the long bond, which is I think what you're describing. So I'm really interested in hearing your thesis on this.
Yeah, absolutely. But let's do some bar trivia first. So, Brendan, if I asked you, and just guess here, how much debt is outstanding in the world, global sectoral debt as of 2025? So this is not US Treasury or government debt. This is not European debt. This is not Chinese debt. It's kind of putting all of it together, government, household, financial, corporate debt. Put it all together. What is that number in your view? Roughly, what do you think it could be?
350 trillion.
Very good. Did you read my paper, by the way?
I do a lot of reading.
Yeah, you do a lot of reading then clearly. So most people say typically 50 trillion, 100 trillion. Now, that number is between 340 and 350 trillion as of 2025. That's the global sectoral debt. Now and that's steadily risen over the last quarter century, Brandon. You could say, Akash, so what? Big deal. Population growth has gone up over the last quarter century. Why shouldn't global debt grow with it? The key is I decompose that data to look at the government share of that debt. And that has also risen to a record level in 2025 at just over 30%. And what's interesting is you can see actually two V shapes that have occurred where the government share of that debt increased and never went back down again this century. One was during the global financial crisis, 2008-09, and the other was during the 2020 pandemic shock. Mm-hmm. So again, we are in uncharted waters, but maybe the argument is that global debt at 3 to 4 times nominal GDP is just too much for the market to bear, or there's just a tail risk there that there could be some restructuring in the future among G10 economies or certainly EM economies. And gold is a bearer asset. It's a physical asset. It is a uncorrelated portfolio diversifying left tail, low volatility asset. The other point that I would make regarding that is if you just look at the debt loads just for government share of debt, that's one situation that doesn't look like it's going to get worse over the next, that doesn't look like it's going to improve, but might get worse over the next few years. So you look at all of the policy uncertainty that we have right now into 2026, geopolitics, what's going to happen with trade and the trade wars. What's the growth outlook going to be? What's the impact of AI, the labor market? I think it's fair to say the one thing that's likely not to get resolved in 2026 is this global debt load that I talked about. In fact, it might get exacerbated. Certainly, the One Big Beautiful Bill Act does that according to the CBO projection window. So taking a step back, Brendan, why do I like gold in this environment? This all links together, but the global sectoral debt has been rising. The government share of that debt's been rising. What's interesting then is look at other asset markets. What's happened with US stock bond correlations? Those spiked to 3-decade highs in 2022, following the 2021 and early 2022 inflation scare, and once the Fed began hiking aggressively to combat inflation. And those US stock bond correlations stayed at very elevated levels through 2022, 2023, 2024. In 2025, they've normalized a bit, but are still positive. So my thesis or my conjecture to you is, do they stay positive? And I think there's an argument to be made that they could, certainly on the long end. Or do you revert back to the pre-2021 2.5-decade regime where you had this inverse US stock bond relationship? And I think because of this sectoral debt that I was talking about, this fiscal impulse globally, particularly on government balance sheets post-pandemic, because of the inflation impulse, are we going to go back to 2% target in the US, for example? Well, the Fed just this month, December 2025, in its updated summary of economic projections, pushed off yet again the 2% target now being hit in 2028. So is 3% the new 2%, for example? Again, I'm not saying that's guaranteed, but that's where rates markets are currently pricing the neutral rate. So if that's the case, you're going to have a little bit more term premium in the long end of the bond curve. And gold then really fits into your portfolio because you mentioned, yeah, historically, I model gold or can model gold as a long duration zero coupon asset. But what if gold actually, instead of just having being a duration asset as a zero coupon, actually becomes a duration hedge because of its diversification benefits and because of what's happening on the back end of the curve? Just give me one more second here. There's a phenomenon that's happening in US rates markets over the last year, which is called bull steepening. You can look at something like the 230 slope that's very telling in that regard. And what that means is, if I look at the 2-year yield, treasury yield, and the 30-year treasury yield, last summer, about 15 months ago, that was inverted. 2-year yields were higher than 30-year yields. And what we've ended up seeing over the last 15 months, and particularly in the 12 months ending September, before the September Fed meeting this year, is a massive bull steepening. 2-year yields were falling because the Fed was expected to cut again. The labor market was starting to weaken. You had some politicization of Fed policy potentially as well. And then on the back end, because of this fiscal and inflation impulse, you had long bonds stay relatively anchored. Now, did they rally this year? Sure. 10-year yields are lower today than where they began the year. But what I think is interesting is that the Fed has cut 3 times starting this September, and 10-year yields are higher today than they were before the September Fed meeting. So what does that say about this fiscal and inflation impulse and how the rates market is actually pricing in what the new normal should be? And I think with that uncertainty, given the stock bond correlation, the level of debt outstanding, this bull steepening bias, which I think a lot of it has run its course, certainly over the next 3 to 6 months, but which has been a huge phenomenon over the last 12 to 15 months. All of that together, all of that combined, I think it creates a perfect storm for gold.
Hey, it's no secret to us. We look at the demographics of this show. We know that a lot of you listening are actually other financial professionals and other investment advisors. We want to go ahead and invite you. If you're looking to do something different in your career, go ahead and reach out. We're always looking to bring on high quality people that understand how to do the planning process, align with our values, and are looking to deliver high value to their clients. Please just go ahead and reach out to us. You can get us on our website, ducharmewealth.com, and we look forward to talking to you. I think you're a lot more sophisticated in the view and thought point and your data inputs than I am for sure. Two of the thoughts that came to mind as you were talking is, will stock and bond correlations return? And I think what people forget is, credit goes in cycles, right? And interest rates thus follow. Maybe they lead. I don't have an opinion on that, but we've seen interest rates come down, right? It's just structurally come down since the mid 80s. And, for older listeners, if you remember interest rates being at, mortgage rates being 15, 18%, then, you know what I'm talking about. And so every time there was a recession or a growth scare or, a risk-off event in the market, and there was this flight to safety, there was a place to flee capital to, right? Which was, hey, bonds are pay. I hope to get 8 or 9% over time in stocks, but bonds are paying 8. So I'll just put more money in bonds, and it pushes the yields down. And so all of a sudden that flight and rotation of capital is what produced that negative correlation, because there was a yield to observe, right? There was a yield to get in the bonds. And I think I don't get any resistance from the idea that bottomed out when the 10-year treasury was at 50 basis points, right? Like you're going to take money and flight to capital into 0.5% a year. There's nothing there for you, right? It can only go at that point. Famous last words for my Swiss investors here, but it can only go up, right? And so I'm actually very leery, I think, right now that will return or normalize back to a negative correlation and provide that benefit. I think I got pretty hammered in 2022 by people calling me like nutty for saying like there wouldn't be a flight to capital or a flight to safety in bonds in 2022 when the markets were crashing. And, I ended up being right on that, but I think interest rates are structurally, they have a structural tailwind now, I think, more than a headwind, right? In terms of them going up, which is bad for bond pricing. And thus the second order of that is it doesn't provide the diversification to a risk portfolio that you might hope. The second thing that came to my mind is, like you talked earlier about like the Nixon shock in 71, right? And I oftentimes, especially in the financial planning space, I'm talking to other financial planners, they show these graphs. Like if you take gold back to 1800 or whatever, right? It's like, it's done barely better than cash. It's like, well, for 200 years of your analysis, it was cash, of course, and so I think like the thing that's a little bit different that people are forgetting is, this is the first time we've really faced these kind of debt loads in a major way, right? We're facing this debt issue, but every major currency in the world is a fiat currency. And so you highlighted out the government share of the debt, which is important because like even if it's like state government, but even like just, hey, me, Brandon, like I can take on a lot of debt, but I got to pay it back. I don't have a money printer. Like the government has a money printer. And that's true not just for US, but that's true in Europe. That's true in Australia. It's true in Venezuela. That's true in Argentina. It's true in the Philippines. Every country has their own currency that they can just print more of. And so all of a sudden you say, man, this is really getting crazy, but there's sort of only one way out for them is you either have to inflict mass pain, economic, recessionary, deflationary pain on the populace, which again, or you have to say, or we'll print more to kick the ball down the road a little further. And the powers that be that are politically appointed and elected generally don't care to have people revolt in the streets over deflation when they have the ability to hit the print button, right? What's your take on that? I mean, am I just a caveman here? Like thinking this?
No, I think some of the points that you're making have started to resonate among a broad swath of investors. Typically it was gold bugs that would talk about, the world falling apart and fiat has no value, et cetera. And I just want to be very clear. I think the fiat system is still here to stay. I don't
Yeah,
think the dollar is going away tomorrow or next year or 5 years from now.
we agree on that.
I think that would create a lot of socioeconomic upheaval, which we couldn't even get to. That would be maybe a separate podcast. That's maybe a more Joe Rogan type of podcast.
Yeah.
But within that context, what I will say is that people are concerned just about the level of debt, the level of money printing, the expansion of what we call M2 or money supply. And it's not just a US phenomenon. It's a global phenomenon. Look at China and the debt that's grown there over the last 15, 20 years as it's grown and looks to challenge the US in a multipolar world. So I think putting all of that, together, one thing that I wanted to highlight before I forget that you mentioned is one, I don't look at the gold market per se prior to 1971, because I think prior to that, like you were saying, it was just a different market. When you're not in a free floating currency environment, when you don't really have the financialization of the asset, it's just different. And even looking at the 1970s analogs, because I do think that's relevant. In fact, one of the reports I wrote that on State Street Investment Management this year is called the Monthly Gold Monitor. It's echoes of the 1970s. So look, I'm respectful of financial history. It doesn't tend to repeat, but it does tend to rhyme. But even there, I care more about recent history. I care more about the post-pandemic regime than I do about the 1970s, for example. And even then, I've seen the memes of people looking at the gold silver ratio going back 2,000 years. I'm like, do we have to go to biblical times to get an answer on the gold silver ratio today? I think that's a lot to swallow. So I think, from my perspective, what are these modern structural drivers, right? We talked a little bit about the ETFs. We talked about stock bond correlations and how that relates to the global debt loads as well that have been rising. But I think there are two other key factors as well, and I'm sure we'll touch on them. One is what's happening with the Fed and the US dollar in the context that you're saying. And in my view, as we started this conversation, the US dollar devalued this year in the first 7, 8 months, the most since the 1970s. So I'll repeat, that's no surprise that gold performed the best since the late 1970s this year, 1979 to be exact. That said, why is the dollar falling? Why did the dollar weaken this year? Well, some of it might be expectations of narrowing interest rate differential. Some of it might be the first half of this year, U.S. growth was quite unexceptional, not exceptional. U.S. growth was very weak in the first half of this year and very dominated by AI-led investment. But I think there's some couple other factors we have to keep in mind. One is U.S. retrenchment and post-Liberation Day Trumponomics, if you will, right? Is that having an impact? At a first order level, you have a White House and an administration, Secretary Bessent, Trump himself. They don't want a strong dollar. They're not fighting a weak dollar. They like onshoring. Their policy goal favors a weaker dollar because they want to re-energize exports. So that's one. But the second is, yes, you've had some impacts post-Liberation Day. Is foreign dollar recycling and foreign demand for U.S. sovereign assets going to be impaired structurally because of U.S. retrenchment and U.S. Trade wars and so forth? Is that going to impact foreign demand for treasuries? And is that having that impact on the curve? So a lot of this is tough to tease out, but when I take a step back, it tends not to be a dollar positive phenomenon, even though I think there's an argument to be made that the dollar stabilizes here after a pretty sharp sell-off in 2025. I would say another point to keep in mind for gold, which is unique, and it's often not touched on podcasts, but I'd be happy to bring it up with you, Brendan, is the physical demand for gold. So I look at gold not just as a financial asset, but as a physical asset as well. And we've talked about some of those physical factors, how ETF is a physical asset actually for gold as well as a financial asset. But what's really unique and want to highlight is the idiosyncratic and non-cyclical demand drivers of gold that make it a unique underlying asset. And what do I mean by that? Central banks, they've been buying records amount of gold since 2022 and the Russian invasion into Ukraine and the weaponization of the US dollar through sanctions. That is non-cyclical demand. Central banks are buying not for generating alpha in year one or year two. They're buying for geoeconomic, geostrategic reasons, for reserve diversification, for de-dollarization reasons, for reducing credit risk on their balance sheets with physical gold. So if you think about that, that is a trend that's likely to continue for many years. It's already been 16 years since the global financial crisis that central banks have become net buyers. I would argue it's 5, 10, 15 years more that is in the cards, if not longer. And if I'm wrong 10, 15 years from now, I'm not sure many people will remember this conversation, so that's okay. And I think then the China story is very important. I talked about China retail briefly earlier. The China retail and consumer demand and Asian consumer demand is very critical for gold, but it's not just, but it's very relevant for gold ETF investors as well, because that tends to be idiosyncratic demand. China retail is not buying because the Fed cut rates yesterday. China retail is not buying because the S&P 500 might sell off or risk on, risk off cycle. China consumers are buying because of capital controls domestically, because their property market never fully recovered from pre-pandemic trend, because their own fears of CNY or Chinese yuan devaluation. And for lack of a better term, gold is democratized in China. You can buy it in 1 gram units, 5 gram units. So I think putting all of this together, you have all of these factors, starting with that structural global debt story, US stock bond correlations, but then you have these new physical factors, US dollar and US retrenchment and geopolitical factors. It really creates this perfect storm for gold. And it really makes it a unique environment in this time period.
Yeah, I think one of the other interesting drivers that's going to be a catalyst or a tailwind for gold here. I think tailwind is a lot more appropriate than catalyst, but I've seen. I will tell you from just a report from the practitioners, in the streets here, right? The last 6 months, like post Liberation Day, and mind you, I review a lot of portfolios for people that are. I work on portfolios with financial planners and advisors at other firms. Our firm, all the new clients that they're bringing on, whatever it might be. And post Liberation Day, I've started seeing more allocation to gold coming in. But what's interesting or unique is you see it 25 basis points, 0.5%, 1%, maybe. I saw bigger allocations when the Bitcoin ETFs first came out. People were bringing in bigger allocations into Bitcoin. And so for me, I'm going, I haven't seen anyone bring in a portfolio actually yet that had silver in it. Which, like, I think when the trade really starts getting exhausted, you'll see a big chase in silver. Nothing like we're seeing yet. But the allocation is really minor. It's almost like, it's going up so much, man, I guess we have to put something, right? But we still don't want it in the portfolios, right? But they got to be able to tell the clients that they got it because it's starting to get talked about. And what I think ultimately ends up happening is it doesn't take much. I hear people say like this framework around small caps a lot, right? Like if you get the cap rotation out of Mag 7 into small cap, you got to remember it's like trillions of dollars going into billions of dollars, right? So all of a sudden the supply demand becomes very inelastic and prices explode to the upside, right? It doesn't take much. And so, gold is, and you probably know the number on the size of the market, but it's way smaller than equities or bonds.
Yeah.
Right? Way smaller.
Yeah, you bring up some great points. So let me tackle two of them. I'll do the latter first. So what is the investable size of the gold market? So here, Brendan, I'm going to ignore stuff like jewelry or gold on your watch, fancy necklaces, things like that, because I think gold is also bought for fashion and it is just a multi-use metal.
Mm-hmm.
So I'm going to ignore like kind of fabrication and jewelry demand for gold and think about who's actually investing in it. So central banks, what are central bank reserves? What's physical bar and coin? What are the ETFs? And then what are the OTC or over-the-counter paper markets related to gold? I think if you add all of this up, roughly as of November 25, it could be about a 15 trillion notional market. Now, we talked about global sectoral debt. That's 340 trillion, but the government share of that debt is over 100 trillion. And then you look at global equity market caps off the top of my head here, they're at least 150 trillion, if not higher. So think about this. We talked about US stock bond correlations. I'm going to try to keep bringing back the main themes because it's all interlinked. If you get even a small allocation globally, a 0.5% shift away from stocks and bonds into gold, which is only a 15 trillion market compared to this 250 trillion plus market I just mentioned, just US government bonds and global equities, that can have a real outsized impact. A 0.5% switch from stocks and bonds into investable gold is, an 18, 19% shock to gold demand, gold investment demand. So that can have that outsized impact on price. So that's number one. I think number two, I want to separate gold being overbought versus overowned. There's a myth in the market that gold is now crowded trade, overowned trade. Your anecdotes, Brendan, tie up perfectly with the flows that we've been seeing and what we've been writing about, what I've been talking to clients about. It's really only in the last 6 to 8 months that we've seen gold ETF inflows and it become a more allocated trade. In 2024, I'm sure you know this, you follow the markets, you're very well read. Gold was also the number one performing US dollar denominated macro asset class globally. Mm-hmm. I'll repeat that. In 2024, gold was the number one performing major US dollar denominated macro asset class. It outperformed the S&P 500 last year, outright and risk adjusted. What we saw as far as global ETF flows, not just the spider, which is the leader in the business, but globally, adding all of the funds in the world up. We basically saw flows were flat for the whole year. And it was the number one performing asset. So I think the reallocation is still in its early innings. And I think it has room to go. So ETF outflows in 2024. And, as you mentioned, Brandon, really only in the last 7-8 months have we seen inflows. But looking at data at the end of October of this year, so it's a couple months, a month and a half prior to us speaking today in mid-December. But even as of end of October, despite the price rally we saw in gold, despite the inflows we've seen in the last 6-7 months, global gold ETFs represented less than 3% of global ETF assets overall. So if you think a fair target allocation is 5 to 10% or even 5 to 7%, that tells you that there's room to grow there. So I think from a lot of metrics, what you can look at are periods like late September, early October, where gold goes parabolic, 3,700, 3,800, 3,900, 4,000, 41, 42, 4,300. I mean, it makes the $700-800 move in a matter of a month. Mm-hmm. Sure, it can be overbought on the technicals, relative strength index, momentum, FOMO, fear of missing out, a lot of this leverage getting into it. But fundamentally, it could be, is it overowned? And I would say from an allocation standpoint, it isn't. So, I think that's an astute observation. It's only really been in 6-7 months. I don't think there have been a lot of strategic core allocations. Some of it might be due to the price. People are scared when asset is at a record price. Do you allocate? Do you dip your toes in, or do you just wait for a pullback?
Wow.
I think from that context, people thought the same thing in January of this year. So the second paper I wrote this year, also in January, was, is it too late to hedge with gold? No. Exclamation point. Unfortunately, the prices then were 2,600. Today, as we're speaking, they're in the low 4,000s, 41, 4,200 an ounce. Do I like it as much? Not as much as 2,600, but maybe instead of saying exclamation point, we're just ... and you still dip your toes in.
Yeah.
As a strategic allocation. The last point I'd make is I'd feel less comfortable with a gold holding today if the S&P 500 was at 5,000 or 4,800 at the lows of April. The fact that equities are in the S&P 500, and here I'm speaking about specifically, are on the doorstep of 7,000 and all-time highs, and gold is also at these levels, that actually makes me a little bit more comfortable, because what happens when there is a volatility shock or a liquidity shock or a drawdown shock next year? We haven't had one since March, April. Then gold really can benefit your portfolio as that left tail safe haven edge.
Well, I think, yeah, I think it's important to note though for everyone too, that, left tail hedges, if you're not directly hedging, right? So like if you get a volatility shock and you own puts on S&P 500, it's going to pay off. It's going to monetize the days that you're expecting it to do it, right? Gold doesn't have to behave that way. And so you shouldn't expect it to, right? And so what I mean by that is you shouldn't expect that if there's a volatility shock like we had, say like April 2nd, that gold is just inversely correlated and starts running up, right? It held its own, it did okay. And then you see a run really quite after. And so what's interesting is, remember, like gold responds, front runs, has all these unique characteristics, but one of the characteristics isn't to be a consistent inverse position on stocks, right? And so, don't
absolutely not.
Don't buy gold because it's like, a cheap put or something, right? Buy it because it's a cheap hedge across time and, space, if you will, right? Like longer periods of time. And in particular, I think like when you see those volatility shocks, you have to really have a game plan. And this is where I caution people to be, from being over allocated to, equities or over leverage when things are good. And, what's the old saying, right? Pigs get fat and hogs get slaughtered, right? Is, you want to be able to buy assets that are on sale. And the other thing is gold would probably respond because, again, and this is my belief, but I think the government and Congress knows they have a money printer and they can, do an unlimited supply. So we get an initial volatility shock, right? You get an initial 25, 30% down. And then when it comes time for, hey, the plumbing's going to crack here in the financial system, and the 10 years knocking on five's door, 5.5, all of a sudden the money printers come on. And I think that's really, gold seems to discount that early, right? And respond favorably. And so that's where, I think you see a really good hedge out of gold, but it doesn't happen on a day-to-day or a week-to-week basis.
No, that's a very important point. It doesn't happen on a day-to-day basis, but if you look on a rolling 1, 3, or 6 month horizon, usually you tend to get some of that consolidation and outperformance, if you will, by having gold as a left tail. What I will say is quite interesting here is, at least it happened twice this year. This goes back to kind of our duration discussion and fixed income discussion. Is twice this year we've witnessed during March April, volatility shock and tariff tensions, and then again in late summer, we saw Fed pricing. So the front end and stir markets, short-term interest rate traders, really pricing a more dovish Fed, but long bonds selling off dramatically, particularly 30-year paper. Mm-hmm. And we even saw this during the immediate aftermath of Liberation Day, when there was a really massive risk-off event, and duration exposure, rather than providing you flight to quality, as Fed cuts were getting priced in immediately, there was actually backing up. And you saw actually 30-year paper actually backed up the most since the early 1980s this past April. In a 3-day, 5-day period window, to be precise. So I think from that standpoint, again, I don't think it's a day-to-day phenomenon or even a week-to-week, but it's more structural. So for me, gold has rebased higher structurally, and the range next year is likely higher, high single digits, low double digits, probably is the baseline return following, 50% plus in 2025. But in that context, I still see the risk skew asymmetric. So if I think about the next $1,000 move for gold, a 25% move from 4,000, let's say, I still think that's more likely 5,000 versus 3,000. So that's how I kind of try to frame it, because I do think day to day, you're right, it's going to move on on other short-term, very technical forces and so forth. But I think the structural tailwinds are what I'm trying to highlight here, at least.
I think there's a structural case for it. I think the technicals look really good. I think one of the things is people are, as they get in invested in gold though, or as they open these positions, it has gone well though. We can't argue that. But listen, like in the technicals world, you could see a retracement down to like 3,600 probably, and you're barely going to break, your primary trend. So you probably have, you know what I mean? Like if gold went down to 3,600, I'm just buying more is likely my sentiment as of today, right this minute, right? Subject to change. But, I guess I'm just illustrating that like right now, like that's the range. So if you're buying at, right now, just close today, just about 4,300, it could go to 3,600. It's a fair drawdown, right?
Mm-hmm.
But realize it's because there's some volatility in that market. A lot of it is upside volatility, which people never complain about. But that when you have the upside volatility, it means there's a presence or the capacity to realize some downside volatility. And so I would caution people from being too optimistic on gold or thinking that it's free money. I actually think we saw that in November when gold really ran up, hit its highs early in the month, and it spiked higher, ran higher, and then it had one down day, and then it came back the next day with like a vengeance. That was like new
Mm-hmm.
all-time high, huge outside day, bullish engulfing candle, right? Like which a lot historically is like that's a very bullish sign. And then the next
Yeah.
day you just saw, and you guys on State Street side, I imagine you guys probably saw a lot of inflows in
Yeah.
that 3-day window.
Can I give you just one point? So, Brendan, I think you're referring to October, not November, as
Yeah,
far
sorry,
as that
correction. Yeah,
next
October.
up. Yeah,
Yes.
no problem. But what I would say is this is interesting, is on that down day where gold ultimately settled down 5.5%, 6%
Yeah.
roughly,
Yep.
was down a little bit more intraday. It had rallied a little bit, but then ultimately it ended up, it was kind of the biggest sell-off that we'd seen in over a decade for the yellow metal.
Yep.
Still saw ETF inflows that day, believe it or not.
Really.
And
I, I,
one other point that I would want to mention just very quickly is that November and December tend to be the weakest gold ETF seasonals historically, even during bull markets in 2024 and in 2020, for example, we saw large ETF outflows in November, December. This year, we're not.
hmm.
So again, I'm not saying that those seasonals are foreshadowing 2026. But what I think it does verify is my point that gold could have been overbought. And certainly when a low volatility reserve
Mm-hmm.
asset goes parabolic, it can be overbought and you're going to have downside volatility as well. But I don't think it's yet overowned. And I think
Yeah.
people are waiting for that pullback. And once it even fell below 4,000 very briefly, you saw a lot of cash on the sidelines get back in on it.
Yeah. Well, I think my point was I think there was some, I'm just going to say like larger players or traders in the market that when it got a little overzealous and the inflows were coming, particularly from the retail side, supporting the ETF flow, you can use futures markets or spot markets to press the price down really significantly. And when you have the chase going, it tends to be a little bit, to borrow some term from the Bitcoiners, right? The paper hands. The guys that they buy and they go, oh man, gold actually isn't a bunch of free money. They're quickly reminded, hey, there's a 6% downside day. I know you got in last week here, you're giving it all back, and you have to be willing. My observation isn't that the markets are broken or manipulated or, how rude of anyone. It's simply, if you're going to get involved in gold, don't think it's a volatility free, just print you some money, protect your capital forever. Like time and, your entry, your timing entry will matter in the long run. Your ability, your financial plan that insulates your ability to stay the course, hold on to it, right? But it is the volatility in gold, in my perspective, that actually is what provides the return over time, right? It's the volatility in of itself that mandates the term premium on it, right? And so it's not free money. Know what you're doing if you're going to get in. Have somebody guide you if you need it. And have the right expectations. And the right expectations is over time, great monetary hedge, great diversifier in a portfolio, probably reduces the overall volatility of your portfolios significantly. But it's not free money. If it was, everyone would buy it and own it.
Correct. I mean, as you mentioned, not everyone knows the term you said sometimes, but it does improve your Sharpe ratio based on research we've done in a typical 70-30 or 60-40 portfolio
Yeah.
over the long horizon. It certainly has proven that historically. Not that
Yeah.
that's predictive of future returns, but it has shown that in the free floating dollar era.
Well, bonds don't have, bonds have a lot of, they can have a lot of convexity, but they don't oftentimes have great Sharpe ratios. So if you pull some bonds out to put in something with a really good Sharpe ratio, it can enhance your risk adjusted return. So 2 cents worth. Well, I mean, I really appreciate, you've got so much great insight on gold and obviously a way more sophisticated and institutional view on the entire situation than I do. But I appreciate you trying to help me make sense of it and help any of our listeners make some sense of it too. I think it's a really key market to keep an eye on and be able to navigate the really quite goofy investment markets we're in these days. I think I look at everything and people say it's an everything bubble. I don't know if I agree with that or not, but it certainly, it doesn't seem to be a market that we're invested in anymore where you say this is a very logical thing at all times and everything's based on a discounted cash flow and a fundamental valuation. I think we're a bit beyond that right now, and it makes it somewhat very uncharted territories, especially when you marry that understanding with the fiat currency situation. It's really peculiar, but I think gold helps navigate this to some degree for a lot of people.
Absolutely. And look, it was my pleasure. I appreciate the questions and the candid conversation, Brendan. And look, our jobs here, my role at State Street Investment Management, your role in wealth management is to help educate our investor base and help them learn and make the right decisions. And what I always like to say about gold is when people say, what's the right allocation? I don't say 100%. If I did, you should hang up this podcast and not listen to me. But I think 0% is too low as well. So it's finding that right balance in your portfolio and showing that how it coexists and interplays with other assets. So one paper I had, we really didn't talk about crypto here, but I wrote a paper a couple of months ago called How Gold and Bitcoin Can Coexist in a Portfolio.
Yeah.
Because when I'm talking to a Bitcoin bull or a crypto native, I'm not trying to get them away from what they're passionate about or what they really believe in. I just want to show them how gold can work for their overall portfolio and actually enhance those Sharpe ratios that you and I were talking about, enhance risk-adjusted returns, reduce drawdowns. And I think that's what I think we're in a unique period for gold here, partly because of the stellar performance it's had in 2024 and 2025. It's getting a lot of attention, but I think also from the fact that people are realizing, hey, maybe I should have a little bit of this asset in my portfolio.
Yeah.
Doesn't need to be a lot, but just a little bit, just to diversify myself. And in case the worst happens, it's good to have at least some of my asset in a kind of a non-cyclical left tail investment hedge.
Yeah. Well, I think if people want to start evolving as an investor and start thinking more like a family that's building wealth, they're going to transition it across generations, I'd encourage them to not fall victim to the or, right? And try to live their portfolio allocations through the lens of the genius of and, right? It doesn't have to be, crypto or gold. It can be crypto and gold. It doesn't have to be stocks or bonds.
Perfect way to say
stocks
it.
And bonds. And it doesn't have to be real estate or stocks. It can be real estate and stocks. And so I think the and part starts to look at blending it all together, using capital efficiency, diversification, asset location, which enhances your tax efficiency, right? And all of these things come together, and all these investments have really unique characteristics. Gold is certainly one of them. And I think doing it the right way gives people a better chance at achieving success,
I wouldn't have said it better myself. What a great way to end the conversation. It's been a pleasure.
Yeah. Well, hey, thanks again. You do a lot of writing. For anyone still listening, where can people go to find, the stuff you're putting out, the writings you're putting out in your papers, Akash?
Sure. State Street Investment Management's website is www.ssga.com. That's ssga.com. You can search for my name or just type in gold on the search bar, and it'll lead you to a whole host of content on the products, as well as research and strategy views, and a lot of white papers on how to think about gold in your portfolio.
Wonderful. Well, once again, we thank you, and we look forward to talking to you again soon.